You ready?
1 second.
Recording in progress.
All right.
Welcome to another Mortgage Express with your Mortgage Express team. Okay, my other half is not here. She had a little appointment she had to go take care of. So I'm Dawn Hall, and Mallory Fraser is sort of here in spirit over here. So today we're going to talk about first-time home buyers, kind of not 101. We're going to bump it up a little bit and not do so much basic, maybe dip in a little bit more with some of the information. If my voice goes out, I apologize. I've been getting over a cold for about 3 weeks, and my voice goes in and out. So got my cup of water here, and okay, go Dolphins, and we'll be talking about that. So anyway, so hopefully this will help you with furthering some information, maybe helping how you find your cash to close, different ways to do contracts and things like that. So let's get started and see what we've got. So today's going to be a little different because, like I said, the first time what we did was we were very basic and kind of touched on a whole bunch of different things. This time we're going to dig in deeper, and we're going to start with cash to close, and we're going to dig in a little more with where it comes from, who it comes from, and all of that. So let's take a look at cash to close. And some of the things with cash to close, one of the biggest things is seller concessions. So with seller concessions, each program, whether it's FHA, VA, conventional, or some of the weird programs that we have like bank statement loans and things like that, have different amounts that sellers can contribute to your closing costs. And again, it can be for closing costs or prepaids. And again, we didn't touch on this the first time, but closing costs are actually the fees for closing, whether it's a lender fee like points or title fees, things like that. Prepaid items are things that are paid ahead of time for you, meaning your prepaid interest. If you close on the 15th of the month, you have interest from the 15th to the end of the month. That is collected ahead of time to make in your payment. Insurances and taxes. We collect your first year of homeowner's insurance up front, and then we escrow for that, meaning they collect 2 months and they put it in, because when you make your first payment, if you close, say, the end of July, your first payment is not due until September 1st. So you have to have July and August in your escrow already, ready to go for next year when it comes around. So a seller can pay up to a certain point of your closing costs or prepaids. So a lot of times your realtor will go in and say, okay, we're going to offer this much money and we want the seller to pay 6% towards down payment or towards closing costs and prepaids. And that helps you not come up with as much money at closing. Another thing you can do would be a lender paid prepay or lender paid concession. And when we say that, it's not that we just give you money, but what we can do is we can do what's called par plus pricing. Basically, if you want a 6.5 rate with no points, maybe we do 6.5 with 2 points. And then those 2 points we can credit to you for closing costs. So that all depends on what the rates are and what the concessions can be. But yes, we can do that as a lender. And one of the other things we wanted to talk about is each state has specific costs that they have to pay. In Florida, we have things like document stamps on the deed. It's a certain amount based on the deed stamps or the loan amount on the deed. They also have HOA fees, condo fees, things like that that are specific for the state of Florida. And we'll have a lot of other things too, depending on where you're buying in the state of Florida. And then other states have different items as well. So those are things that we look at state specific for closing costs. And if you have any questions, just drop it in the chat below, and Ashley will holler at me at the end and we'll answer some questions for you. So let's talk about a little bit about pre-approvals. We talked a lot about that in our earlier one, that you want to get pre-approved before you go looking for a home. So let's dig a little deeper into pre-approvals. There are 3 types of approvals. There's a pre-qualification, there's a pre-approval, and then there's an underwriting pre-approval. The underwriting pre-approval is always the best, because what that has done is we have actually taken your application, we've run your credit, and then we have also taken a look at all of your documents, and we sent it to an actual human being person that underwrites your file. And then once you get that approval does not have to be updated unless you go and any documents have to be updated. So that is always the best. That's almost like making a cash offer because you're already approved. A pre-qualification doesn't hold a lot of water because basically you've given some information. We've said, yep, based on what you said, you are qualified. Doesn't mean you are really approved, just means you're qualified. A pre-approval is the next step above where we have pulled your credit and we've actually done maybe an automated approval, something that goes through the computer system and approves you. That way we know that you're approved. We just have to get the documentation and send it in for an actual person to then tell us about that and tell us whether you're approved or not. The things we use on pre-approvals and underwriting pre-approvals and everything, first thing is your debt to income. Debt to income means your debts versus your income. So we have guidelines based on your credit scores as high as we can go on your credit guideline. So we're going to take, again, any debts that you have, whether it's a car payment, a credit card, a student loan, we're going to take those debts and then we're going to divide it by whatever income you make, whether it's W-2 income, commissioned income, or bonus income. So we're going to take all of those numbers and we're going to come up with a number. Generally, it needs to be 50% or below in order for us to do an approval for you. So sometimes if you're only using your income because maybe your wife or partner does not have good credit, so we do it just for you, but you have 2 car payments and all the credit card debt, it may not work. We may require you to pay off some credit cards or some debt to help get your ratio in line. A lot of people get worried about credit inquiries. Yes, it's important to make sure you don't have a ton of credit inquiries, but when it comes to mortgages, the credit company looks at it a little differently. If you have several credit inquiries from mortgage companies within a certain time period, generally it's about 14 days, but if you have them all at one time, they count it as one inquiry. Even though you do have to explain the inquiries, the credit bureau only calls for one inquiry. So it's only hitting your score one time. And a lot of things to remember too is if you have a higher credit score, those inquiries do not affect your credit score the same way as if you start out with a lower credit score. With a lower credit score, everything hits your score. So just be careful that while you're looking for a house, you know, if you call somebody and you're talking to them about what kind of programs they have, make sure that they don't pull your credit. If they say, let's get you approved and you're not ready to get approved, don't give them all your information. Wait until you're ready. Doesn't mean you can't call that person. Doesn't mean you can't get an idea on what kind of rates they have, what kind of programs they have, or maybe even get a feel for the loan officer. Decide if you like the loan officer, if that's someone you want to work with. Then go back and get your scores pulled and get everything done to do a pre-approval. Not many places do a full underwriting pre-approval, but we here at Van Dyke do. We want to put you in the best position you can be in order to get you approved and to get you that house that you want. So let's move on to the next thing. Down payment assistance. Oh, this is always a good one. And we get asked this a lot about down payment assistance. And all the states have some of their own individual down payment assistance programs. And other states have not many or some, it just kind of depends. There are also national programs, and then there are also some specific programs. We have at Van Dyke, we have two that we can offer $2,500 to $5,000 of down payment assistance, and that is through Van Dyke directly. So that is something that we can do. Some of the programs for Florida, one of the biggest ones that just started yesterday is our Hometown Heroes program. Great program for first responders, teachers, nurses, that kind of thing. There are qualification things that you have to fall within. But if you have questions about it, give us a call. What you can get is up to 5% of the loan amount with a minimum of $10,000 and a maximum of $35,000. So that can be used for down payment, closing costs, or prepaids. So sometimes that amount of money could be the difference between getting the house with the pool or the house without the pool, or maybe just the house in general. Maybe you don't have enough money. Maybe you've only got, $10,000, or you're only getting a gift from a family member for a certain amount of money. That could be the difference between getting into the house now or versus waiting until you've saved more money. So that's the first one, Florida Hometown Heroes. Don't forget that one. It's a great program. We also have some Florida Assist and Florida Housing. So going in conjunction with the Florida Hometown Heroes, Florida also offers sometimes $5,000 to $10,000 towards down payment and closing costs for middle to low income people who have incomes that fit in that middle to lower income. That could be something, again, that could help you with your closing costs. Sometimes if you get the seller to do a concession and then you get the assistance, then sometimes you don't need any money to close. Basically, you can use the assistance from Florida and get your whole down payment covered and get the concessions from the seller to pay your closing costs and prepaids. I've seen it happen. It can happen. So if you question any of that, definitely give me a call and we can talk about that stuff. Then there's also the Lee County and the Fort Myers programs. We have what's called bond programs. And again, different programs for different incomes of people. And it does help, again, with down payment and closing costs. And if you come to me, what I do is I take a look at all the assistance that's available, whether it's city, state, or national, and see if you qualify for any of that. If you do, we get it, and then we get it on for your loan. So definitely give us a call. Some of the other programs that help with lower down payments would be FHA, 3.5% down. Conventional does have Home Ready and Home Possible, which are 3% down. Difference between FHA and conventional, FHA is a little more lenient on its credit guidelines and also on the income, how we document income and how long you've been on your job or not been on your job. So those sometimes will tell us which program we should go for first. USDA, great program if you live in an area that is considered a rural area. And we do have many of those out here in Fort Myers area. We have them out in Buckingham, Lehigh area, East Fort Myers, quite a few out that way. And what USDA does is they will do 100% financing, and actually they will go up to 102%, meaning they will contribute 2% towards your closing costs. So That being said, if you have a seller that pays some of your closing costs and you do USDA, you could get into that house with no money out of your pocket. So it's definitely something that would be good to look at. And we do those a lot in the middle of the state. And again, here at Van Dyke and here in our Fort Myers office, we can lend anywhere in the state of Florida. Just give us a call and we can look at that for you. Let's see what's next. Next would be talking about some rate buy downs. Now, when I talk about a rate buy down, there's temporary rate buy downs, there's permanent rate buy downs, and then you also can negotiate some of the rates and things like that. So with a permanent rate buy down, basically you're going to pay points to lower your rate. So let's assume that today rates are at 6%. With no origination. Maybe I could do 5.875 with 1 point. That would be a permanent rate buy down, that you are buying that 6% rate down to 5.875 with 1 origination. And when I talk about negotiating too, you can negotiate and have the seller pay your points. Maybe they only want to give you a credit of maybe 2,000 or 3,000, and maybe that's just what you need to buy a point to get your rate down. So that again is a way to do that. A temporary buy down is what we call like a 2-1 buy down or a 3-2-1 buy down. And what that is again, let's assume rates today are at 6%. And let's assume you do a 2-1 buy down. So in the first year, you're going to go down 2%. So instead of it being 6, your monthly payment for that first year is going to be based on 4%. And then the next year, it's going to be based on 5%. And then the third year, and for the rest of the loan, you will have a 6% rate. Now, with a temporary buy down, you as the borrower cannot buy it down. That would have to be a seller negotiation. So when you're looking at things like that and you want to buy that rate down, then you have the seller pay a certain amount of costs to negotiate that and to get that buy down. Because what they do with that temporary buy down is the difference in the payment between 4% and 6% goes into an escrow for that whole first year. The second year, 5% and 6%, the difference, all that goes into an escrow account. So that amount of money over here is what the seller is going to pay at closing to be used to credit towards your closing costs or to your rate or your monthly payment. And a lot of builders will do that. A lot of builders build that into their purchase prices. So that is always a way to take a look at getting you maybe a lower rate. Maybe you have higher debts and you feel more comfortable with a lower payment first. And then maybe you pay down some of your debts, and the next year you go up a little bit higher in your monthly payment, and you now have some debts, but you're getting rid of those. And then by the third year, when you're up to that regular payment, you now know how much your payment is, and you can handle it that way. So that is a good way to do buy downs, temporary buy downs, and full and permanent buy downs. Ooh, all right. And that's new for this session, so that was a fun one. Tactics for competitive market. So what we're going to talk about is getting your offer accepted. There are a lot of different ways to do that. And if you're competing with somebody on a purchase, and maybe you need to sell your house first or something like that, they can accept your offer, and a lot of times they will put what's called an escalation clause in there. Let's assume they accept your offer at a lower amount or something like that, but you have to sell your home. Well, then if somebody else makes an offer of the same, they could escalate your payment. Basically say, okay, we're escalating this. Either you can do it now, or we're taking the other offer and taking that off the table. So sometimes when you put that clause in there, it helps you to get the offer, But sometimes you have to be careful, because if you don't sell your house on the back end, you might lose that house. Another thing would be appraisal gap coverage. Something to the effect of, if the appraisal comes in low, you still will take the appraised value and buy the house. So meaning, if you make an offer of 400,000 and it appraises at 395, we are going to loan on the appraised value or the purchase price, whichever is lower. So we are going to do a loan based on that 395. Now, maybe that buyer or seller has said, we're not going to take anything less. You've given them an appraisal gap and said, we'll take it no matter what. That means you would have to come up with an additional $5,000 to purchase that house. Now, sometimes that's a win. Sometimes it's not. It's entirely up to you, but that is a way to ensure that your offer gets accepted where someone else's does not. And then one of the other things is, and this is why we always tell you to get a realtor. Get your own realtor. Don't necessarily go looking at houses and just go to the listing agent and go talk to them. Find a realtor that you like to do business with that is your agent. They are the agent for the buyer, and they take you to houses. You give them what you want them to do, look for. They find houses for you, and they help you go and look at houses and find out, and they check the market, and they help you make the offer, and they build the offer. They also read the seller's listing agent. They can tell and talk to the listing agent and find out, what are the seller's trigger points? What will make the seller want to sell you that house? It could be a short closing. And if you're already pre-approved through underwriting with us, maybe closing in 2 weeks is what gets you the deal, and that's what makes the sellers happy about that. Or maybe the sellers are more focused in on the price. They want their price. So your agent knows, I'm not going to go in at 10,000 below and ask for 6% in closing costs, because you're never going to get the deal. He maybe will go in at the full price and ask for closing costs, or something like that. So your realtor knows how to read the listing agent and talks to them about how to make that offer. So those are the ways for working in a competitive market to try and get you the house you want. And of course, again, I keep going back to, the biggest thing would be having a full underwriting pre-approval, because it's almost like cash when you go to make an offer. Okay, now the coordination. This is a big one. We work with, and I personally work with, a lot of realtors, and we feel here at Van Dyke, coordination and communication is huge. We will update both the listing and the selling realtors every Tuesday on all the loans. We do not go through you as the buyer to figure out what's going on with your realtor and all. We are very upfront with them. We are in touch with their transaction coordinators. We keep everything going. We are very communicative to make sure that you and the realtors know where everything is. So should there be a problem that comes up, everybody is aware and everybody works together, because nobody wants the deal to fall apart and nobody wants the deal to not close. Everybody, wants to help you buy that house. So one of the biggest things that is really good with working with a realtor and your lender is that we communicate together, and we really do that well. Let's see, we don't go just through you. Just wanted to point that out as well. Some of the mistakes we see, which is a new one again for this season, mistakes that we see most often, and we hate to call them mistakes, but they are things that could derail your approval. one of the biggest mistakes is when you go out and you make a major purchase. Now, because you've gotten a purchase or an approved contract on a house and we've approved you through underwriting, does not mean this is the time to go get a car or go get $3,000 worth of furniture or anything like that. Wait until your house is closed, because especially if your ratios are really close, you could buy something that could throw you out, and now you've got furniture for a house you can't afford. So make sure we don't do big purchases, and don't try to hide it. I tell everybody all the time, I'm your doctor, I'm your attorney, whatever it is, buyer privilege, tell me everything, good, bad, all of it. So that way I know how to direct you and how to put together your loan to make sure everything goes smoothly and we get you approved. Another thing that happens quite frequently is you switch jobs. Now, I'm not saying that you don't take that promotion. If you're staying with the same company and it's a promotion from maybe an hourly to a salary, or maybe an hourly to a higher hourly, maybe it's a higher salary, that's great. You know, call me first, let's discuss it. But if it's a promotion or a change, even in the same company, if you're going from salary to hourly, because you're going to get a bunch of overtime now, not good, because we have to average overtime over 24 months. So that would not be a good move. Same thing if you decide to go to the sales department in your company. You don't want to do that, because going from a salary or an hourly to a commission, again, commission, you have to be 24 months, 2 years, in order for us to average that money. So you want to make sure that you don't change. And then the other thing is don't go from one company to another company that are not related at all, unless you're getting a super huge raise and it is a guaranteed salaried amount. Because that, again, when you change companies, we don't know that you have history in that. What if you change companies and you go from, I don't know, doing title work on cars to selling real estate? They're right there. Those are commission. You don't have a history of that. We have no way to know that you're going to continue and make money. So those are two of the biggest issues that we see. The other one that's more suited towards you and your property, a lot of people decide they don't want to do a home inspection. Now, as a lender, we do not require a home inspection. We do an appraisal to make sure that the house appraises for what you're buying it, to make sure it's in the market. Now, if an appraiser sees something on the ceiling like water spots, he may call for a roof inspection. Or if maybe you're walking through the house and the air conditioner doesn't seem to be cooling down, he may call for a air conditioning inspection, an HVAC inspection, but he doesn't have to. So if you skip your home inspection, which the home inspector will go out and inspect the whole home. They also do a 4-point inspection for you, which you need for your homeowner's insurance to get the lowest possible homeowner's insurance. If you skip that, then what's going to happen is you will not know if anything's broken or if anything needs to be fixed. And the seller that would again be in your negotiating to have the seller either fix it or give you a credit so that you can fix it. If you go into that house, remember, you close on that house, you now are a homeowner. So anything that gets broken or anything that happens after you take possession of that house is on you. So if you have not done a home inspection and your air conditioner goes out the day after you move in, you excuse me, you are stuck. Excuse me. And then the last thing we see would be not budgeting. And that kind of goes with that home inspection. When you budget, make sure that you're not living for the house and you have no money to put in savings afterwards. Because if that happens, when the air does go out, or you need a plumber, you don't have any money. And remember, when you move into that house, when you move from an apartment to a house, you're gonna need hoses, trash cans, lawnmowers, all kinds of stuff like that, that if you have not budgeted for that, you're gonna be stuck. So definitely don't do any of those mistakes that we see very, very often. And wow, kind of went quicker without Mallory. Well, not really, I talked a lot. But anyway, questions, anything out there, Ashley? Do we have any questions?
I think we do. Hold on.
Awesome.
A look here. Questions. We have a couple in the chat.
Awesome.
Okay. We have one from Bailey. It says, what is the biggest difference from pre-approval to underwritten pre-approval? When does it matter that I need that?
Well, again, the biggest issue is with a pre-approval, I've done the credit and we've talked to you about it, and we've done a computerized approval. The full underwriting approval is you have gone all the way to underwriting. We have collected your pay stubs, your documents, all of the information, and that person, the underwriter, an actual physical person, has underwritten your file. And you really want to do that while you're looking for a property, so that when you do find your property, then we can close much quicker. And that could be the difference between you getting the offer accepted versus someone else.
Okay, we have one from Tom.
Tom?
Yes.
Hi, Tom.
How do I decide whether to ask for seller concessions, a rate buy down, or just lower the price?
Well, that's something you kind of talk to your realtor and myself. And here's the thing. If you don't have a lot of cash, then what you're going to want to do is maybe use your concessions for closing costs and prepaids. Maybe if you have sufficient cash, but you need maybe the rate to go down to help you qualify, then we use the concessions towards doing a permanent buy down on the rate to make it so that you now qualify. So the best thing to do would be to sit down with me when we're talking and we find out what you need, and then between us we decide, okay, this is what you qualify for, and if you can get the seller to pay 3% in closing costs, then that'll work for you, and then we put it wherever it needs to go, and then I work with your realtor making the offer.
Okay, and this last one is from Tracy. She says, should a buyer still avoid the things you mentioned after going under contract to when they close?
I would imagine that avoiding the items would be like buying big ticket things or changing jobs. And if that's what you're talking about, absolutely. Once we get you approved with underwriting and underwriting approval, and you're looking for a house, don't make any changes. Again, if you get offered a promotion, call me, we'll talk about it, see if it's something that is going to help you. But once we get you underwritten approved and you are actively looking for a home, you don't want to make any changes until you found your home and we close your loan. Once your loan is closed and you own the home, you can do whatever you want and enjoy your home. Well, that was fun. And that was for first-time home buyers. Not sure what we're doing next month. It might be something for investors and all that. Keep an eye out on my Facebook page and anywhere else, maybe on YouTube, and check and see. And if you have any questions, I'm Dawn Hall, minus Mallory Fraser. We're your Mortgage Express team, and I am at 239-789-7561, and I am your lender for life.